Hey everyone, hope they're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in. Take a look, see what is going on today. If you want to follow me at _finance, and if you want to join our community, finding-value.com, I dive deeper into all this stuff, looking for investment opportunities, sharing that with everyone in the community. We do have a coupon code. It's in the corner there. It is special is the code for savings on both the monthly and yearly memberships. Starting with urine, he says, with the big beautiful bill now law and expected to add $5 trillion in debt, the question is whether the U.S. economy's speed limit can be raised enough to avoid a debt spiral down the road. The simple math is that the economy needs to grow faster than its cost of borrowing. That has generally been the case over the years, and when it wasn't, the debt burden was too low to matter. But as the debt burden grows larger, the differential between the 10-year yield and the long-term growth rate in GDP will become all important. If the term premium rises to 150 basis points, which seems reasonable to him, especially as the dollar loses some of its safe haven status, and the long-term growth rate in potential GDP slows to 4% per the CBO's forecast, the math will become more challenging, to the point where the Fed may have to step back into the markets and execute some version of yield curve control, YCC. That's fiscal dominance in a nutshell. So what is it? Let's look at the graph here. This is what he's talking about. So what we want to see is we want to see growth over the interest rates. So looking at the 1970s, we had strong growth, which is the nominal potential GDP 5-year change turn higher. And then behind it, we saw interest rates, or the 10-year treasury yield, move behind it. So we always had the blue GDP line going over the green line. So GDP was growing faster than interest rates. At some point, interest rates were above GDP. It slowed everything down, and we had a long period from 1982 where GDP and interest rates both fell and bottomed roughly in 2020. We were in a, quote, Goldilocks period from the early, say, 2008-9 area all the way till what could be coming out in the future here, 2026, 2027. That's kind of where we get this cross. That's where growth rates are greater than interest rates. But that could change out here in the future as we go past, say, 2026, 2027. That leaves us susceptible to GDP growth rates falling underneath our interest rates. And that's a combination of GDP falling and interest rates going up. And we get that cross at 26, 27. That could potentially be a problem if our debt level is where we're at up here, well over 100% debt to GDP. That could be a problem. This one here, this is money in the Fed, U.S. nominal GDP and U.S. M2 money supply going up together. This is Fed's balance sheet on the bottom there in the purple, U.S. monetary base as it goes on up, and then Bitcoin market cap as percent of GDP is 6.3% there. And he added that in there as additional information. HFI research, if it can often feel like all hope is lost in the natural gas land, and while the cash market remains weak, fundamentals are starting to tighten. Lower 48 gas production has dropped back to 105.5 billion cubic feet per day, which has pushed net gas supplies lower year over year by 2 billion cubic feet. Now we need heat. So here's production. We're up there. We've come back a little bit on the top side there. This is net natural gas supplies year over year. You can see that we are negative. We're pulling back over last year. You can see it's below last year. So that's what we're seeing from 25 versus 2024. We have been producing a little bit more nat gas over these past months, and we have seen a decline in rig rates. And I think eventually it's going to impact production over time. This here is your power burn. So power burn demand on the left-hand side and total gas demand. The winter obviously has more natural gas demand than the summer. The summer still goes up, but it isn't as much as the winter that we use for heating our homes. But here's power burn. We're pretty close to last year. It really depends on the heat. If we have a hot summer, we burn more electricity for air conditioning versus, say, other years. So that also depends on weather. Natural gas is very dependent on weather, obviously. And this is lower 48 production in billion cubic feet. You can see we're hanging up there quite a bit. We're over previous years in the lower 48 production. Energy headline news. OPEC estimates total oil sector investment needs will increase to $18.2 trillion by 2050, up from $17.4 trillion in 2024. Calvin says the deficits have completely distorted everything. The deficit is the economy. And Diamond says real data on the U.S. economy totally impossible to read. I agree. I think it is incredibly impossible to read the data on the U.S. economy. Deficits are the economy now. I agree with that. Fiscal dominance could be out in the future if GDP does go underneath interest rates, and we are running fiscal deficits. So is that overpowering everything else? Is it overpowering all of the real data on the U.S. economy? It seems like it is. I also think that they're playing with numbers left and right. I think they're playing with unemployment. I think they're playing with inflation. That also means that they're playing with GDP and all these other things. So yes, I think it's all being handled, put it that way. Christine says the global age of natural gas is still ahead of us. HENG Hemel. Alex says, so we need to advance the equivalent of 4 new Canadas when it comes to fresh barrels by 2050, with minimal capex, price volatility, and ongoing layoff programs. Cool. And again, that goes back to global demand. We need 4 new Canadas. Global oil demand is set for continued robust growth, reaching almost 123 million barrels per day by 2050. While non-OECD oil demand is projected to increase by almost 28 million barrels per day over the outlook period. OECD oil demand is set to witness a decline of 8.5 million barrels per day. So we see OECD a decline and non-OECD going up. The difference here, this is the world total demand. What we're seeing from 2024 is about 103.7 in 2024. In 2030, we're looking at 113.3. 2040 is 120 million, and 2050 is 122.9 million. I'm not even sure if we can produce that or not. I don't know. That's a lot of oil. 122.9 million barrels per day. All right, boom, silver futures on the loose as we start to break through resistance in the shorter term to the upside. It's always on the 4th attempt. So we could be breaking on silver. What does that mean? It means a big move is possible that's coming up here. When we break through these levels, this one's 37.50 roughly. we could see less resistance, overhead resistance, which means we can run. Now, if we run out of this small pattern, it breaks bigger patterns. The 45-year downtrend or 45-year cup and handle pattern in silver could be broken with this breaking out here. Then it's a crescendo of not much overhead resistance and all these patterns breaking. The pattern is the resistance. So as we break and as we move, we could see a big move in silver. Now, what does that mean? It means that the silver equities, which I think are very well aligned, could see a ridiculous move. We're coming from very cheap valuations. All the ratios look good. SIL-J divided by silver itself. If silver makes a gigantic run, we could see a 3 or 4x multiplier on top of silver for the mining companies. And the patterns, some of these mining companies could even do better than that. They are ultra leveraged. And if we get a big move in silver, I think money flows are going to come running at it. So this looks absolutely excellent. Silver, platinum, and palladium alert from Bob Coleman. He says EFPs, exchange for physical spreads, are rising rapidly today. Silver EFP up 70%, platinum EFP is 3x, and palladium's EFP is 2x. This may be associated with the copper tariffs concerns. Premiums started to rise on silver 1,000-ounce bars. Exchange for physical spreads. Looking good. Good. Now, I'm not sure exactly what this exchange for physical spreads actually means, so I'm guessing it is the exchange to get the physical metal, and that's the spread between maybe futures and that. But yeah, these spreads are going up. OPEC expects global oil demand rise to 123 million barrels. We've said that one before. Freight futures AM update. Dry bulk is ribbing. Capesize up 5%. Panamax up 7%. Tankers, VLCC is down 1%. Suezmax is flat. We've already talked about that. No demand peak in sight for oil. Perhaps OPEC is sick and tired of fake source leaks. What's going on there? He says, in 25 years covering the oil market, I've never seen anything like this. OPEC has widened its media ban, this time excluding the WSJ, NYT, FT, Reuters, and Bloomberg, including myself, from attending its biennial industry conference in Vienna. Probably because they're lying. They're probably getting bought out and trying to hold the oil price down. They're like, get out of here. David Burrows, if you like long-term charts and big bases, it's pretty hard not to be bullish. The new secular bull market to join precious metals and uranium is copper. Copper's got this big consolidation in the shaded pink region, and we are breaking out of that shaded pink region, about to start a green region. Big moves occur after these big consolidations, and we could see a very big move in copper. Giant and supergiant oil fields are thought to provide 50% of the world's oil. The average age of these monsters is 64 years old. Demand continues to grow unabated worldwide. Enjoy the show. And what does he mean by enjoy the show? These old monsters are starting to deplete, and they're starting to roll over. A lot of them have already rolled over. Some are rolling over, and some are rolled over down a little bit and plateauing still. As these deplete, I think it's going to be pretty difficult to replace production from them. These are the high return on investment oil barrels. So your energy return on energy invested, it's very good from these big oil fields. Most of them are conventional, so they're high net earning ones with low decline rates. The decline rates could be between 5 and 10%, depending on the field. The newer stuff, much smaller oil field sizes, much smaller reserves, and the depletion rates are much higher. We're talking 40, 50, 60, 70% decline rates the first year. So totally different fields. I think this is going to get real interesting here over the next, say, 5 years even. We'll see how much we can produce for oil and see if we can hit some of these levels at maybe 110, 115 million barrels a day. We'll see if we can get there. Logan says purchase applications data update plus 9% week to week, plus 25% year over year. 23 straight weeks of year over year growth. 10 consecutive weeks of double digit growth. Let's review, since I know some of you are confused by this data line. So this is the mortgage purchase application index, and we're a lot higher than 2024. People are looking to buy, it looks like, and they're applying to mortgages. So that's good. We're also seeing that in the real estate home builder stock charts. Those are also looking pretty strong. And that's what I've got for today, guys. So that's where we're gonna end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Use that special coupon code. We've got a Q&A session coming up on Sunday, 5 p.m. Mountain Time. That's all I've got. So we'll catch you next time. This is Finding Value.